As we head towards the end of the financial year, it is yet again the events unfolding in Greece that has investment markets fixated. The standoff brewing between Greece and its creditors since the start of the year has now reached a crucial phase, and while a deal urgently needs to be made, the situation clearly remains tense. We know next week is the first critical deadline, as this is when Greece's current program expires and a payment of €1.6 billion needs to be made to the IMF on the 30th of June. Not long after that, a further €3.5 billion falls due to the ECB, and then payments are owed to pensioners and government employees. In the absence of further bailout funding, it's apparent Greece doesn't have the money. It makes you wonder if a cut in pensions is more appealing than no pension at all. The reaction of Greek depositors clearly shows that they are fearful a compromise won't be met in time. Greek banks have been reeling from intense withdrawals over the past week, with over €4 billion reportedly leaving the banking system. The ECB has been doing its bit by providing emergency liquidity assistance, and without its support, some form of capital controls would likely be necessary. The latest proposal from the Greeks has at least provided a semblance of progress. However, there will be lots of toing and froing before next week, as not all conditions of the creditors have been met. The proposals haven't been approved by ministers in Athens either, and there is no guarantee they will pass given the stance of some members of the ruling party. The ultimate outcome remains hard to pick. Whether it be a Grexit, default, or a hybrid solution, we know the vast majority of Greeks want to stay in the euro, but brinkmanship and a relatively inexperienced government increases the chance of an accident. Not surprisingly, sentiment has been hit by Greece over the past weeks, and the market reaction seems to be quite binary. Up on good news, or the prospect of good news, and down on the bad. So what could happen if it still all goes pear-shaped? Well, we have been led to believe that markets are better prepared than 2011, but only time can, or possibly could tell. A disorderly default and Grexit could blow out the bond yields of Spain, Italy and Portugal, so the actions of the ECB to minimise the threat of contagion will be crucial. However, the bigger question then becomes the future of the euro. If Greece were to leave, it offers a precedent to others who may wish to do the same. Of course, the pain that may incur on Greece could act as a deterrent, but if it doesn't, are we prepared for that? For investors, it remains sensible to keep risk management front of mind, as trying to time the market on this type of short-term noise is next to impossible. A well-diversified portfolio remains a good starting point to mitigate risk, but for those who remain cautious on equity markets, investing in low volatility equity funds is another way of gaining exposure to shares without riding the highs and lows of market sentiment. A share portfolio that is able to utilise exchange-traded options can be managed to generate attractive levels of income at lower levels of volatility than the overall market.